Hi guys, it's Stock Curry, and the stock market just had one of its worst days in months. I'm going to explain exactly why the stock market fell today, and then I'm going to give you my prediction on where I see the stock market going for the rest of this year. So let's get into it. The stock market had its worst day in 3 months as recession fears grow. Before the market started selling off on new recession fears, the market started selling off very early in the morning due to some data that came out of Europe. The European Central Bank, as well as the Bank of England, raised rates by 0.5 percentage point. The Swiss National Bank also made a similar move. Now, on one hand, this should have been good for U.S. stocks because as central banks in Europe raise interest rates, more money flows into the European economies due to the higher rates that bond investors can get on their investments. And this normally would send the dollar down, and we did see the dollar fall. Now, as the dollar falls, that usually causes the stock market to rise, especially on large international organizations, because it improves the exchange rates that these companies get, which in turn improves their earnings. So we may have expected the stock market to rise, but we actually saw the stock market fall. And the reason for this is because even though the higher interest rates do bring down the dollar, which is good for stocks, unfortunately, rates are being raised at the same time that there are major recession worries in Europe. And in fact, 2 European countries already believe they are in a recession, with many other companies on the verge of recession. And with all of these countries either in recession or near recession, this is causing a lot of fear on the stock market, including the U.S. stock market. Don't forget that during every major recession in the past, the worst recessions have actually been global recessions. So there's a very good chance that this recession in Europe could spread to the United States and make the U.S. recession even worse, as it hurts our exports and further lowers our GDP. At the same time, the European Union is dealing with high inflation and a looming recession. They are also raising taxes. This will further hurt earnings. And as earnings continue to drop in Europe, that again will lower the amount of exports we have here in the US, which in turn will lower our US stock prices as well. And that is what kickstarted the sell-off in stocks on Thursday. However, that wasn't the end of it. There was some significantly bad economic news in the United States that really spooked investors. Retail sales fell 0.6% in November as consumers feel the pressure from inflation. This drop was twice as bad as what the market had predicted. What really makes this bad is that we're talking about a month-over-month decrease, meaning consumers spent 0.6% less in November than they had in September. Now, in any other given month, this probably would not be that big of a deal. However, we're talking about November here. We're talking about Black Friday, the month where consumers are supposed to spend more than they do in any other month of the year. And did the amount that consumers spent go up? No, it actually went down. And that was not good news for the economy, earnings, or the stock market. Now, I know what you must be thinking. Well, okay, so people spent less in retail stores. That makes sense as people are spending more and more money online, right? Well, unfortunately, wrong. Online sales also decreased, falling 0.9%. You might also think, well, okay, maybe people are spending more money on services and less on goods. Unfortunately, bar and restaurant revenue was down 0.9% also. Across the board, sales were down, and this is pointing very strongly to a looming recession here in the United States. Of course, the largest portion of the U.S. economy is the housing market. And we already know that mortgages and home sales are down, as well as home prices falling. And this is now leading to home flipping profits dropping at the fastest pace in over a decade. Investors are quickly pulling out of the market as profits drop. The last time we saw a decline in profits from investors like this was in 2007 and 2008. We are facing the same sort of housing crisis just like we saw in 2008. Now, it may not be as extreme as it was in 2008, but home prices could still fall by the same amount because home unaffordability was at its highest level, exceeding the unaffordability situation that we were in 2007. So because home prices were so much higher this time around, they could fall by just as much or more than they did in 2008. That would spell further disaster for the U.S. economy, and it is one of the things that Jerome Powell said in his speech that he is worried about. And even in the midst of today's downturn in the market, there were a few notable losers, one of them being Roblox, which was down over 15%. Roblox shares fell after their November update showed slowing growth. Revenue for the month of November was down almost 9%. This is further leading to recession fears, especially amongst online companies. And it wasn't just Roblox that got hit either. Netflix shares were down over 8% on the day. This after DigiDay announced that Netflix let advertisers take their money back after Netflix missed their viewership targets. Even on Netflix lower tiered ad supported version, there just weren't that many people signing up for Netflix, and this caused Netflix to badly miss their targets. That means that their promises that they gave to advertisers for the amount of ads that viewers would see fell significantly below expectations. And in turn, Netflix is now returning money to advertisers. This all spells disaster for Netflix, and that is why the stock was down significantly today. So with all of the doom and gloom that we got in the market today, where do I see the stock market going for the next 2 weeks through the end of this year? Well, technically, we closed below a very strong support level on Thursday. That support level at $393.50 on SPY, which is an S&P 500 ETF. That level has not been broken in over a month. And we finally closed below that today, which points to extreme bearishness over the next 2 weeks. I think it is safe to say that the Santa Claus rally is canceled and we will not be rising this year like we normally do. Now, I do want to give one warning to everybody for the very last day of the year. Normally, on the very last trading day of the year, we will see a pretty significant stock market sell-off as large institutions sell stocks in order to do something called tax loss harvesting. And you may have heard other YouTubers talk about tax loss harvesting, how this can cause a downturn in the market on the last day of the market as large investors try to lower their tax burden by selling some of their losing stocks on the last day of the year. Unfortunately, you have to understand that tax loss harvesting is only effective during a bull market. There is no reason to lower a tax burden when your entire portfolio is down 5, 10, 20% on the year. The stock market is in the middle of a bear market. Most investors have lost money this year, which means investors do not have to offset profits in order to reduce taxes because they're already not going to pay any taxes because they didn't make any money. And that means we may not get that last day of the year tax loss harvesting sell-off like we normally get. So don't plan on that happening this year. Don't plan on companies selling their winning stocks for a profit only to rebuy them in January. That most likely will not happen this year. You have to understand that a lot of historical trends have been broken this year, including some 80 and 100-year records. Things that have always happened in the last 80 or 100 years failed to happen this year. It is just one of those years where we are in a terrible bear market, and it's all leading up to a major recession in 2023. Now, a little bit later in the year, I will provide an expectation on where I see 2023 going. For now, let's just focus on finishing out this year. And be careful. I do not think this is the time to buy the dip. I think this is the time to short the market. And if you want to learn how to make money as the market goes down, then make sure you join my coaching program where I will teach you how to trade options, including some of the more complicated and more profitable multi-leg options, so that you can make money as the market goes down. If you're interested in joining that coaching program or you want to learn more, get your questions answered, then schedule a call with an onboarding specialist who can explain everything to you. And together, you guys can see if this will be a good fit for you or not. You can contact an onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And make sure you hit the like button and subscribe. And if you want to know more information about how the Fed raising interest rates is going to affect you personally, then make sure you watch the last video that I uploaded here.